The event unfolded quietly, but carried the unmistakable characteristics of a financial stress signal. On Friday, January 9th, a substantial quantity of physical silver was removed from COMEX depositories in a single session. A total of 2.7 million ounces left the vault system, not as a bookkeeping adjustment or internal reclassification, but as metal physically exiting storage. This distinction matters because it separates routine paper movements from a tangible loss of inventory. When metal leaves the vault, it is no longer part of the system that underpins futures contracts and delivery obligations. This withdrawal was not isolated or symbolic. The volume involved was large enough to immediately draw attention to the condition of the physical market beneath the surface of daily price action. The term run on the bank is typically associated with depositors rushing to withdraw cash when confidence in a financial institution weakens. In this case, the behavior was mirrored in the silver market. Holders with the ability to take delivery chose not to roll contracts forward or leave metal in storage. They removed it entirely, signaling a preference for possession over promises. What makes this event notable is not only the size of the withdrawal, but its timing and concentration. The removal occurred in a single day and affected multiple major vault operators. This pattern suggests coordination rather than coincidence. In stable conditions, physical inventories tend to change gradually. Sharp, synchronized withdrawals indicate urgency. They imply that certain market participants are reacting to incentives or risks that outweigh the costs and logistics of moving heavy industrial metal. At its core, this episode highlights the difference between paper liquidity and physical availability. Futures markets can function smoothly even as physical stockpiles shrink, as long as confidence remains intact. When that confidence erodes, the focus shifts from price exposure to supply security. The act of withdrawing metal becomes a statement about trust in the system itself. This initial event sets the foundation for everything that follows. A sudden drain of physical silver is not just a data point, it is a signal. It raises questions about why the metal was taken, where it is going, and what pressures are building beneath the market's surface. To understand the implications, it is necessary to examine how this withdrawal unfolded and what mechanisms made it possible. The withdrawals that defined the event were concentrated and specific, unfolding across several of the most important COMEX vaults. On that Friday, the metal did not drift out in small increments. It moved in large, deliberate blocks from identifiable storage locations. Asahi, Brinks, and CNT all reported substantial reductions in their silver holdings. Each withdrawal represented physical bars, leaving secured facilities, not transfers, between accounts or internal ledger adjustments. At Asahi, a significant portion of the outflow drew particular attention because it included metal removed from the category designated for delivery. Roughly 1 million ounces were shifted out of registered status, meaning that silver was no longer available to satisfy futures contracts. This action reduced the pool of metal explicitly pledged to meet delivery demands. The remaining withdrawals at Asahi, combined with large movements at Brinks and CNT, brought the total for the day to 2.7 million ounces. The pattern of these removals matters as much as the total volume. Multiple vaults experienced withdrawals within the same narrow time window. This consistency suggests that the actions were driven by a shared incentive rather than isolated decisions by unrelated parties. Physical silver is cumbersome to transport, insure, and relocate. Participants do not typically incur those costs without a clear and compelling reason. The speaker emphasizes that this was not a cosmetic change designed to influence reported inventory levels. The bars were loaded out and removed from the system entirely. Once gone, they no longer contribute to the apparent depth of supply supporting the futures market. This distinction separates routine inventory management from a stress response. In calm conditions, metal often shifts between eligible and registered categories without leaving the vault network. Here, the metal exited altogether. The scale of the withdrawal also places it outside normal daily fluctuations. COMEX inventories can change modestly from session to session, but a multi-million ounce drawdown in a single day stands out. Such a move signals urgency and conviction. Those removing the metal were not speculating on short-term price movements. They were acting to secure physical supply. This concentrated raid on the vaults reframes the price action that accompanied it. And while the market closed near the same levels observed in prior sessions, the underlying inventory had materially changed. The visible calm in prices contrasted sharply with the physical stress beneath. Understanding why this happened requires looking beyond New York and examining the external forces pulling metal out of the system. A critical element of this event lies in the distinction between different inventory classifications within the COMEX system. Not all silver held in COMEX vaults serves the same function. The category known as registered represents metal that has been specifically designated and approved for delivery against futures contracts. This silver is effectively the last line of physical backing for the paper market. When it remains in place, the system appears stable, even if large volumes of contracts change hands. During the Friday withdrawal, a notable portion of the metal leaving Asahi came directly from this registered category. Approximately 1 million ounces were removed from registered status, immediately reducing the amount of silver available for delivery. This was not a theoretical adjustment. Once metal exits this classification and leaves the vault, it can no longer be used to satisfy delivery obligations. The pool of deliverable supply shrinks in real terms. The significance of this action lies in what it implies about priorities. Moving metal out of registered status signals that the holder values possession more than participation in the delivery mechanism. It reflects a decision to opt out of the system that supports futures settlement. In ordinary circumstances, registered inventories tend to remain relatively stable because they provide flexibility and liquidity to the market. Their sudden reduction introduces tension between paper claims and physical availability. This shift also alters how remaining inventories should be interpreted. Reported totals may still appear substantial, but the portion that is actually committed to delivery has been reduced. Each ounce removed from registered status increases the relative pressure on what remains. The system becomes more sensitive to additional withdrawals or delivery requests. The event underscores how quickly the structure can change without dramatic price signals. Prices may hover near familiar levels, while the foundation beneath them erodes. The removal of registered silver transforms a large inventory number into a smaller, more fragile base. It forces market participants to reassess how much metal is truly available when obligations come due. By itself, this reclassification would already be meaningful. Combined with simultaneous physical withdrawals, it becomes a warning sign. It suggests that certain participants no longer view registered silver as a strategic asset within the COMEX framework, but rather as metal better held outside it. To understand why this preference emerged, attention must turn to the forces operating beyond the New York market. The motivation behind the sudden drain of silver becomes clearer when the focus shifts away from New York and toward Asia. A powerful external force was at work, described as the Shanghai magnet. This concept refers to the price disparity between Western and Chinese silver markets and the pull it creates on physical metal. While inventories were shrinking in COMEX vaults, silver in Shanghai was trading at a noticeably higher price. At the close of the trading session, silver in New York settled at just under $80 per ounce. In contrast, the same metal in Shanghai closed several dollars higher. This difference was not marginal. It represented a clear and measurable profit opportunity for anyone capable of sourcing physical silver in the West and delivering it into the Chinese market. The incentive was tied directly to the metal itself, not to futures contracts or financial instruments. This price gap transforms global silver flows. When a higher price exists in Shanghai, metal is naturally drawn toward that market. The movement does not depend on speculation or sentiment. It is driven by arbitrage. Physical silver leaves lower-priced markets and migrates toward higher-priced ones. In this case, New York became the source, and Shanghai became the destination. What makes the Shanghai magnet particularly powerful is the structure of China's silver market. China maintains export restrictions on silver, which means that once the metal enters its system, it does not flow back out. The movement is effectively one way. Silver that leaves Western vaults to satisfy Asian demand is permanently removed from the Western supply chain. This dynamic explains the urgency observed in the vault withdrawals. The arbitrage window created a rare opportunity to capture a premium by relocating physical metal. Participants with access to COMEX inventories acted decisively. The cost and effort of moving silver were outweighed by the price differential and the strategic value of securing metal in a market where it commands a higher valuation. The Shanghai magnet reframes the withdrawals as a rational response to global pricing, not an anomaly. It shows that the silver market is no longer governed solely by Western price discovery. Instead, physical flows are responding to signals from the East. To fully understand why this gap exists and how it drives behavior, the mechanics of the arbitrage itself must be examined. The price difference between New York and Shanghai created a clear arbitrage mechanism rooted in physical movement rather than financial engineering. When silver closed in New York at a lower level than in Shanghai, the spread represented an immediate profit opportunity. By sourcing metal at the lower Western price and delivering it into the higher-priced Chinese market, participants could capture the difference per ounce. In this case, the gap amounted to several dollars, a meaningful margin in a market where transportation and logistics costs are well understood. This arbitrage is distinct from paper trading strategies. It does not rely on leverage, derivatives, or short-term price fluctuations. It requires physical possession of silver and the ability to move it across markets. That requirement limits participation to entities with scale, infrastructure, and access to vault inventories. As a result, the activity reflects the decisions of well-capitalized actors rather than speculative traders. The existence of this spread also reveals a divergence in how silver is valued across regions. In New York, pricing is heavily influenced by futures markets and paper liquidity. In Shanghai, Pricing reflects immediate physical demand within a system constrained by export controls. When these two pricing mechanisms diverge, metal flows toward the market where physical scarcity is most acutely expressed in price. The persistence of the arbitrage gap indicates that the market is not easily self-correcting. Under normal conditions, price differences narrow quickly as supply moves to equalize valuations. Here, the gap remained large enough to motivate sustained withdrawals from Western vaults. This suggests that demand in Shanghai is strong enough to absorb incoming metal without driving prices back down to Western levels. For COMEX, this dynamic introduces structural pressure. Each ounce shipped out reduces the inventory supporting futures contracts, while the paper market continues to function as if supply remains abundant. The arbitrage therefore accelerates the drain on physical stockpiles without immediately disrupting price signals in New York. This mechanism helps explain why the withdrawals appeared deliberate and coordinated. Participants were not reacting to intraday volatility. They were executing a strategy based on a stable price differential and a clear path to profit. Once initiated, this flow feeds on itself, as reduced Western inventories make each remaining ounce more valuable to those seeking physical control. The arbitrage window does more than move metal. It exposes a fault line between paper-based pricing and physical demand. That fault line becomes even more significant when the destination market is effectively a dead end for supply. Understanding that one-way nature is essential to grasping the long-term implications of the current drain. A defining feature of the current silver flow is that it does not operate as a circular trade. The movement of metal into China represents a permanent exit from the Western supply system. Once silver enters the Chinese market, it is effectively locked in place. Export restrictions prevent that metal from being shipped back out to respond to higher prices or tighter conditions elsewhere. This structural reality turns what might otherwise be a temporary arbitrage into a lasting reduction of available supply. In markets without such constraints, price differentials tend to resolve through two-way flows. Metal moves toward the higher-priced market, increasing supply there and easing prices, while shortages in the lower-priced market drive prices up. In this case, only one side of that adjustment is possible. Silver can move into China, but it cannot return. The normal balancing mechanism is broken. This one-way flow amplifies the impact of each withdrawal from Western vaults. Every ounce that leaves reduces inventories that support futures trading and delivery obligations. There is no offsetting inflow to replenish those stocks. Over time, this dynamic compounds the effect of daily withdrawals, turning short-term arbitrage into a structural drain. The permanence of the flow also alters decision-making. Participants understand that once the metal is shipped, it is removed from circulation in Western markets. This increases the urgency to act, while inventories are still accessible. It also reinforces the preference for physical possession over paper exposure. Holding claims on silver that no longer exists within the delivery system carries an obvious risk. This structure explains why the withdrawals are interpreted as a signal rather than a routine trade. The decision to remove metal from COMEX and send it into a closed system reflects a judgment about future availability. It suggests that those involved expect physical silver to become more difficult to obtain in Western markets. As this process continues, the focus shifts from the absolute size of inventories to the rate at which they are disappearing. The pace of withdrawals becomes the critical variable. To assess how long the system can sustain this outflow, attention must turn to the concept of the burn rate and what it implies for remaining registered supply. The scale of the withdrawals brings the concept of burn rate into sharp focus. Burn rate refers to the speed at which physical silver is being removed from the system relative to the total inventory available. At the time of the event, total registered silver on COMEX stood at approximately 123 million ounces. This figure represents the metal explicitly available to meet delivery obligations. When viewed in isolation, that number can appear reassuring. When viewed against the current pace of withdrawals, it takes on a very different meaning. With 2.7 million ounces leaving the system in a single day, the math becomes unavoidable. At that rate, the entire registered inventory could be exhausted in roughly 45 trading days. This is not a projection based on accelerating demand or hypothetical stress scenarios. It is a simple extrapolation of an observed withdrawal pace applied to known inventory levels. Even a slower rate would still imply a rapid drawdown by historical standards. The importance of burn rate lies in how it shifts attention from totals to time. Large inventories can give the impression of security, but if they are declining quickly, that security is temporary. Each trading day that sees a similar withdrawal reduces the remaining buffer. The margin for error narrows, and the system becomes increasingly sensitive to additional delivery requests or unexpected surges in demand. This perspective also reframes daily vault reports. Rather than treating inventory changes as background noise, the burn rate turns them into leading indicators. Consistent withdrawals signal ongoing pressure. They suggest that the forces driving metal out of the system are persistent rather than episodic. The burn rate concept highlights a key vulnerability in the structure of the market. Futures trading volumes and open interest can remain high even as physical backing erodes. As long as confidence holds, this imbalance can persist. Once confidence falters, the speed at which physical inventories decline becomes decisive. Understanding burn rate is essential because it bridges physical reality and market psychology. It quantifies how long the current structure can endure if conditions remain unchanged. However, the raw inventory number still overstates true availability. To fully assess risk, it is necessary to examine how much of the remaining registered silver is genuinely willing to be sold or delivered. The concept known as the sticky ounce theory challenges the assumption that all registered silver is equally available to the market. While the reported figure of 123 million ounces suggests a substantial reserve, this number does not account for the intentions of those who own the metal. Registration indicates eligibility for delivery, not a commitment to sell. In practice, a portion of that inventory may be functionally immobile. According to this view, many holders of registered silver have little incentive to part with their metal at current conditions. Some may be long-term holders who value physical possession over short-term price movements. Others may be strategic actors who registered silver for flexibility, not because they intend to deliver it into the market. As a result, the true supply that would respond to delivery demands may be significantly smaller than headline figures imply. This distinction becomes critical during periods of sustained withdrawals. As metal leaves the system, the remaining inventory increasingly consists of ounces held by participants least willing to sell. Each subsequent withdrawal therefore removes metal that was relatively easy to mobilize, leaving behind ounces that are sticky. The effective supply tightens faster than the reported totals suggest. The sticky ounce theory also explains why physical stress can build without immediate price dislocation. As long as a small portion of inventory satisfies delivery needs, prices may appear stable. But once that flexible layer is exhausted, pressure increases rapidly. The market can transition from apparent abundance to scarcity in a short period of time. This dynamic compounds the implications of the burn rate. Even if the pace of withdrawals slows, the composition of remaining inventory matters. A shrinking pool of willing sellers increases the risk that delivery demands will collide with resistance, forcing adjustments elsewhere in the system. By recognizing that not all registered silver is truly available, the inventory picture becomes more fragile. What looks sufficient on paper may be inadequate in practice. This gap between reported supply and effective supply sets the stage for the final pressure point in the system, the imbalance between paper claims and physical metal. Beyond the pace of withdrawals and the stickiness of remaining inventory lies a deeper structural imbalance. The system supporting silver trading carries a large volume of paper claims relative to the physical metal available for delivery. At the time of the event, there were approximately 700 million ounces of paper silver claims outstanding against roughly 123 million ounces of registered physical silver. This creates a ratio approaching 6 paper claims for every ounce of metal. This leverage is not unusual in futures markets, where most contracts are settled financially rather than through delivery. Under normal conditions, only a small fraction of participants seek physical metal, allowing the system to function smoothly despite the disparity. The risk emerges when confidence shifts, and more participants choose delivery over cash settlement. The withdrawals from COMEX vaults amplify this risk. As physical inventories decline, the same volume of paper claims rests on a shrinking base of metal. Each ounce removed increases the leverage ratio, even if the number of contracts remains unchanged. The system becomes more sensitive to any increase in delivery demand. This imbalance is described as a leverage bomb because it remains dormant until triggered. As long as market participants trust that physical metal will be available if needed, the structure holds. When that trust weakens, the disparity between claims and metal becomes a point of stress. The incentive to secure physical supply increases, reinforcing the very behavior that tightens availability. The leverage bomb also explains why physical withdrawals are closely watched by informed participants. They are not merely inventory changes, they alter the risk profile of the entire market. Each reduction in registered silver raises the stakes for those holding paper exposure. In this context, the run on physical silver takes on broader significance. It is not just about where the metal is going, but about what remains behind. A heavily leveraged system depends on stability and confidence. When large actors choose to remove physical metal, it signals a shift in that confidence and increases the potential consequences of further stress. As this pressure builds, attention naturally turns to price thresholds that could accelerate the process. One such level sits just above where the market closed, carrying both psychological and mechanical implications for the balance between paper and physical silver. As the physical drawdown unfolded, the price of silver hovered just below a critical psychological level. The market closed at $79.91 per ounce, placing it within cents of the $80 threshold. This level carries significance not because of any formal rule, but because it represents a widely recognized marker for market participants. Prices approaching such levels tend to influence behavior, particularly among those holding short positions. The proximity to $80 heightened the tension already present from the physical withdrawals. The expectation described was that when Asian markets opened, silver could move directly above this level, creating a gap higher. Such a move would leave little opportunity for short sellers to adjust positions gradually. Instead, they would be forced to respond after the price had already moved, increasing pressure on those betting against higher prices. A move through $80 also has implications for supply behavior. As prices rise toward and beyond prominent milestones, existing holders of physical silver may become less willing to sell. Higher prices validate the decision to hold metal and reinforce the perception of scarcity. This reluctance further constrains available supply at the very moment when demand for physical control appears to be increasing. The focus in this environment shifts away from intraday price fluctuations and towards structural indicators. Vault reports become more informative than short-term charts. The ongoing removal of metal signals that large participants are prioritizing physical ownership. This behavior suggests a lack of confidence in paper representations of silver and, by extension, in the broader monetary framework that supports them. The event is interpreted as a strategic choice by well-capitalized actors, sometimes referred to as whales, to secure tangible assets rather than maintain exposure through contracts. Their actions are not framed as speculative trades, but as reallocations in response to perceived risk. The preference for physical silver over paper claims implies concerns about currency stability and the reliability of financial promises. Taken together, the approach to $80, the accelerating physical drain, and the behavior of large holders form a coherent picture. The market appears calm on the surface, but its foundations are shifting. The run on physical silver is not presented as a conclusion, but as a signal. It reflects changing priorities and growing pressure within a leveraged system, where confidence and availability are increasingly in tension.